Assalamualaikum warahmatullah everyone. Welcome back to our discussion on the deposit taking Islamic bank. I was emphasizing on the fact that Islamic bank today is leveraging on deposit fund to make Murabaha or to make tawarruk, and that is the modality adopted from conventional banking, and this has provide great challenges for Islamic bank to use al-bay' or sale as the Quran has prescribed over riba. Now, if we were to see an example where if the Islamic bank intend to use sale, whereby, as I say, sale is a transaction evidencing the transfer of ownership from the selling party to the buying party, the taking of ownership risk by the selling party prior to the resale to the buying party on deferred payment. So these are the two important characteristics of sale: the transfer of ownership from the bank to the customer, and the taking of ownership risk by the bank when in the resale transaction, which is the Murabaha transaction. So one of the products that has been commonly used or documented in the guideline of the Central Bank of Malaysia is the Murabaha by purchase order, or MPO. And this is again a sale product whereby the bank will receive a purchase order from the customer who intend to buy or to own a certain machinery or a certain equipment that comes under object finance, and this transaction are documented in the CAFIP 2019. CAFIP is Capital Adequacy Framework for Islamic Bank 2019, published by Bank Negara Malaysia. And we can see that under the market risk chapter, there is a guideline to indicate how much capital charges needed to do MPO. So let us see here. So the central bank, the case here is that the MPO is financed by deposit fund of 100 million, and the size of the MPO is 100 million, and the risk weight accorded by the CAFE using credit risk weight is 187%. So this is MPO without waad, meaning that the bank does not require the customer to legally purchase the machine or the subject matter. So there is no contract tied into this MPO, and therefore the customer can decline the purchase if desired. So this is a risky MPO, and therefore the credit risk weight accorded to it is 187%, or using the basic indicator approach under market risk, it is 15%. So if you were to calculate the capital requirement for this MPO at 187 risk weight percent, based on minimum capital of 10.5%, we can see that the calculation is similar to what we did earlier. That is, the capital requirement will be equal to the minimum CAR ratio of 10.5%. So in decimal, it will be 0.105 multiplied by 187%, which is based on the conversion factor, it becomes 1.87. Then multiplied by the 100 million worth of MPO, and you can see now that the capital requirement has risen, from 12.5 million earlier in the loan example, unsecured loan, to 19.6 million So for the same amount of exposure, now the bank, if they wish to do MPO, which is a real sale, meaning that the bank will actually purchase the machinery from the supplier and hold it on their banking book, and then they will sell it to the prospective customer. And that MPO, whereby there is no waad, there is no legal requirement for the customer to purchase. The customer may finally, exit the transaction, and the bank will be caught holding, that particular machinery that it doesn't want, and therefore the exposure to loss will be much, much greater. So that is why the RW is raised by the central bank to 187, and therefore the amount of capital needed to be held by the bank to support this exposure is very, very high, and that is the deal breaker for Islamic banking, because this is an awesome amount of capital that is very stressful to the Islamic bank, to do, and therefore that is why we can see that doing sale under the pretext of MPO is not viable, simply because the bank is operating based on deposit fund. It is the deposit fund that is financing the MPO, and the depositor do not carry any risk. These risks are shifted to the bank, and the bank is the entity that will be absorbing these losses arising from the MPO. And due to the nature of the MPO without waad, then even though the MPO may generate high profit, but the danger of loss is much greater, and the amount of capital the bank need to fork out is a lot more, and that is why MPO and many of the sale contracts are not viable to Islamic banking today, simply because the bank is using a deposit fund, which is a debt fund, to finance the MPO. Very interesting topic for us to further discuss. Inshallah, I will see you again, and please comment, share and subscribe. Thank you very much. Assalamualaikum warahmatullah.